Yeah,
Look at his face.
yeah. Too up, too down.
Look at his face.
Yeah, yeah. I wanted the crown and to be celebrated. I rented a tux and I ordered a mink. Stood in the mirror like mama, I made it. Proceeded to brushing the teeth in the sink. Caught me a grill and I'm so melanated. I polished the chain, I ain't gold in the link. And I got me a baby who gave me some babies. I'm raising a lady and building a king. Too cold. You too busy running with another man lane, I guess. Yeah, too bold. I be running on the one way, never change my set like I don't ever use my signals. Yeah, I be in the lane myself. Yeah, I don't gotta change my mental. Yeah, and I ain't gotta chase my wealth. And I accept my daddy got a kingdom, and everything I ever got is his. If I ever got a problem, I'ma seek him. I never doubt him. Been about his biz, oh man. Been there. I ain't gotta ride on the wave when the ocean is his. Close with the kid with a
What's good, baby? It's your boy Dale. I'm back in the saddle again. Our motto is to buy, build. We already bought it already, so we already own it, free and clear. Refinance to long-term debt, cash flow. That is the motto. Cliff, man, is that a pretty strong motto, man? What do you think?
Man, the model is strong. Like, you're getting each piece of the invest, right?
What's good, baby? It's your partner looking oh so fresh, cold, clean, and looking better than you. It's all good, baby. Don't get mad at me. Talk to Jesus about that thing. But guys, welcome again to another edition of Real Estate Friday Live. Just going to be me today, guys, man. And you know how we begin it every single time. We're going to dive right into it with the current market analysis. Now, before we dive into that real fast, if you could share, like and subscribe. You're getting some value, guys, and click on that little bell, no matter if you're on Rumble or YouTube, to get alerted when I actually go live and talk about what's going on. But let's dive into the current market analysis, guys, of what's going on in the marketplace right now. We know we're in a changing marketplace, and we're very close to election season. We're really at the end of election season, and things can kind of go, can change on the dime. Now, why am I saying this? Well, there was a lot of bragging going on when it came to the rate cut of the Fed cutting the rates, and people kept saying we have to wait till the Fed cuts the rate. And when we do that, you'll begin to see a spike in a good a way for the real estate industry, the market itself. Well, something has actually happened post the Fed rate cut, guys. Interest rates have exploded, guys. Man, let's dive into this information, man, and see what's going down, guys. And then we can kind of comment on what's really behind this. Here we go.
We got to talk about the massive surge in interest rates that is happening across the U.S. economy right now. This is something that absolutely no one expected after the Fed rate cuts. The 30-year fixed mortgage rate is now spiking to almost 7%. And this suggests that the market is baking in inflation expectations into the future, that 2025 might be an inflationary year for the U.S. economy, and that the housing market and the labor market are going to slow further due to these surging interest rates. Let's take a look at this, everyone. Over the last month, the 30-year fixed mortgage rate has skyrocketed from 6% to almost 6.9%. In addition, the 10-year Treasury yield, the amount the U.S. government has to pay on their long-term bonds, has gone up to almost 4.2%. Again, the highest level in 3 months. And this is, of course, a big problem for the housing market, everyone.
I told you guys, don't just look at the Fed rate cut. Look at what's going on with the Treasury yields and the T-bills. Look at what's going on in that bond and Treasury market at the government level, guys. He just spoke about it. Once you look at that, you begin to see what's really going on behind the scenes. Let's keep going. Here we go.
Because all the players in the housing market were banking on Fed rate cuts to lower interest rates and stimulate buyer demand, but the exact opposite is happening as we speak. It almost seems as if the Fed has lost control of the economy and of the yield curve. The Fed has got to be really concerned right now because they did a 50 basis point rate cut in mid-September. And it's almost as if the market is saying, we don't care about that. We think you made a mistake. we think inflation is going to get worse in 2025, which is why the bond yields are going up. And I think it's the investors in particular that are really worried right now. I'm going to get to how these rising interest rates affect you as a home buyer later in this video, but I'm going to start with investors.
Listen
these
to this,
investors
guys.
cannot make any money right now on their investment properties, and many are already selling. Like on the house.
The reason why is because they bought terrible. They bought it at a retail price point. Some even paid 25, 30% over retail cost to buy a whole entire subdivisions. These are new construction properties, right? And then when they were buying constructed properties, because they bought it so bad right up front, these are bad investments. So therefore, you have to charge a higher rate because you are paying a higher rate. When it comes to rental rates, you have to be able to cover the debt service. And when you buy bad, you get this in return. This is why I was saying, guys, when it comes to the real estate market, yes, the Fed did cut the rate half a point. That was a big cut initially, right? But then what's actually happening, there was the variables that people were not factoring in, which was the debt to income ratio, or the DTI. People's savings are at record lows, right? And the credit card debt are at record highs, right? Also, when it comes to people's income, is not outpacing inflation, right? The inflation rate, right? So it's stagnant right now. So there's no confidence when it comes from a lending standpoint for a lender to lend you out money. And number two, the consumer cannot afford these higher interest rate payments because you got to pay principal, interest, taxes, and insurance, and sometimes even PMI, depending if you're a FHA borrower. So again, those were the two variables that I was saying that a lot of investors and retail buyers were not paying attention to. Let's keep going, guys. Here we go.
Behind me here in St. Petersburg. This is a house that a big Wall Street investor bought in the middle of 2022 for $550,000. They have since put it on the market for sale and have now priced it at $430,000. So this Wall Street investor, an entity called SFR Acquisitions 2, who owns tens of thousands of homes, they're getting out of the market. They're taking a $120,000 loss from what.
That sounds like an institutional investor. That the company that he said that actually owns his house, that sounds like an institutional investor, a hedge fund of some sort, right? Here we go.
What they purchased it for 2 years ago. Now you guys can let me think, do you think $430,000 is a fair price for that house? It looks like it was flipped and renovated. It was sold a couple times over the last several years. It was flipped and renovated. Now the investor's taking a $120,000 loss. That's the biggest loss I've seen yet for an investor down here in Florida. I've shown you guys $30,000 losses. I've shown you guys $80,000 losses. That's a six-figure loss. It's the first six-figure loss I've seen. And so when we're already seeing investors sell and sell at losses, that's telling you the market's shifting down, the inventory is increasing.
Yes.
But then when you couple that now with the interest rates spiking, you say to yourself, well, just how bad could this investor sell-off get? Because get this, everyone, real estate investors across America own 24 million homes, which is approximately 25% of the entire housing stock in America. 1 out of 4 homes is owned by an investor. Now, about 10% of those investor-owned homes are owned by Wall Street investors. Another 30 to 40% are owned by medium-sized investors that own over between 10 and 100 homes. And about 50% of those homes are owned by small investors. So we have widespread composition of that investor ownership. And if these investors have to refinance their debt or take out new debt to purchase properties, they're paying 6 or 7% and they're losing money. And folks, I kind of want to spend some time explaining.
This is because those investors, whether it be institutional, mid-size would be myself, as well as a small investor, right? You bought terribly. You make money in real estate when you acquire, not just when you actually sell. And most investors lack the, I would say discipline, but lack the know-how to buy a property at the right price point in a changing market, right? Man, this is good. Let's keep going.
Explaining to you here how investors look at the housing market and why the investor demand spiked during the pandemic, but then has gone way down over the last 2 years, and investors are now selling. Because I think it's important that you guys understand this from a fundamental perspective. So the way that investors make decisions.
And here's what I say before he goes into investors, right? And I'm glad he's talking about investors right now, right? This is going to be a major opportunity for those wise investors, those sophisticated investors that can know how to vet a property and structure the deal the right way. A crazy opportunity is here and will be here for the next 3 to 5 years. Listen very carefully to what he's talking about.
Decisions on buying houses is on something called the spread between investment returns and the 10-year U.S. Treasury yield. This is how
another word for spread is delta, profit margin. Know these terms.
All big investors, institutional Wall Street investors, make their decisions. And you can see here on this graph, over the last 12 to 13 years, we're tracking the difference between the cap rate for rental properties and the 10-year U.S. Treasury yield. So the cap rate, again, is what you can get in an unlevered return annually from an investment property. The 10-year Treasury yield is what you could get on a government bond, which is a risk-free bond. What you notice is that from 2011 to about 2021, the return on real estate, the cap rate, was significantly higher than the return on the 10-year government bond. We were at around a 5.5% to 6% cap rate if you bought a rental property, compared to around a 3% 10-year Treasury yield, which meant that the spread that you got as an investor by buying a rental property was about 2.5% to 3% above what you would earn buying a government bond. And that positive spread of 2.5% to 3%, that's what incentivized all the investors to pile in the late 2010s, and especially in 2020. 2020, the first year of the pandemic, that was the peak spread we saw of real estate out-earning government bonds. However, as you can see, this situation has changed considerably. Basically now, there's no spread, no return that an investor would get from buying real estate above U.S. government bonds.
Look at that.
Which is why the investor purchases have plummeted. Because it just doesn't make financial sense to take the risk of buying an investment property if you're not going to make any money, really.
Because you don't know, this is to investors, how to buy at the right price point. There's a plethora of deals out there if you know how to vet and structure a deal properly. Now, this is very, very simple to see. And to kind of go back, he said cap rate, guys. I'm going over these terms too. Cap rate is normally, the term cap rate is normally used in the apartment arena of investing, and that's fine. And I use a cap rate when it comes to me actually acquiring apartment complexes. I don't use a cap rate when it comes to me actually acquiring single family residences or SFRs. I don't need it at all. I have a target of what I want to make on a monthly basis from a dollar amount, and my whole goal is to meet that target. Now, if you use a cap rate for SFRs or multifamily, that's fine. Do what you do. If it's working for you, do what you do. As for me, I don't use a cap rate in the SFR or multifamily space. I only use a cap rate in a apartment complex space, if that makes some sense. But let's keep going.
Above government bond returns. I mean, why would you buy an investment property and go through and risk maybe losing money on the value, risk the rent going down, risk the property taxes and insurance going up, and then deal with all the headaches of being a landlord if you could sit on your couch and get the same amount of money just by going to Treasury Direct and buying government bonds? You wouldn't. And so this is fundamentally what explains the oscillation in investor purchase demand. There isn't some big conspiracy about investors buying homes. It's simply a function of, does the return on the house exceed the return on the bonds? And right now, the answer is no. And this is what makes the recent surge in interest rates so problematic. Right? Is that the Fed cut and everyone thought that the long-term bond yields would go down. Well, now they're going back up, meaning that housing, real estate investment is becoming actually less attractive even than it was 2 months ago to these Wall Street investors.
And notice how both the presidential nominees, Donald Trump and Kamala Harris, are talking about we need to build more homes. How are you going to do this without incentivizing home builders and also incentivizing home buyers? There has to be some type of plan put in place to make it easier to borrow debt to acquire property, right? And lessen the burden on investors, i.e. builders, to be able to build at a lower cost because of inflation, right? But at the exact same time, that cost being so attractive that they can give out more incentives to the new consumers coming in because the consumers have a benefit of coming and buying because of a lower rate. This is going to be a very interesting into 2024, 2025, and beyond. For me, my plan is I'm ready for either option, whether it is a Kamala Harris presidency or a Donald Trump presidency. I'm ready for either option because I know, and I'm not bragging, but I know how to acquire properties at the right price point, no matter the market. And I know what markets to go in or what not to go in. For example, guys, I don't go into marketplaces to those major areas, guys. I don't do that at all. The reason why is because everyone else flocks there. And so for me, what's a major area? Dallas, Fort Worth, and I'm in Texas, Austin, San Antonio. Let's go outside and go to Florida, Miami, Fort Lauderdale, Palm Beach, Florida. Let's go over to nowhere in California, Los Angeles, San Francisco, New York City, nowhere really, the whole state of New York and the whole state of Illinois and the whole state of California. Why? Because in those areas, the laws from a state standpoint do not benefit investors, right? And so I know what areas go. I like mid-tier towns, Waco, Texas, towns in Alabama, Mississippi, Temple, Texas. Those mid-tier areas they actually have a healthy growth and a healthy population there, and the marketplace is already at the bottom as far as price point. Now, I'm not really worried about inflation type of scenario there because most of the population is coming from New York and California. They're flowing to the Austins, to the Miamis, to the Fort Lauderdales, right? So that you're going to see an inflationary event, which is what we saw when it came to the inventory. I told everybody in 2021, Austin is going to be very inflated, Austin, Texas. And you bet you're behind. And after 12 to 18 months after that, Austin spiked. It spiked because of the population that was coming from Cali, Oregon, Washington State, New York State, New Jersey. They were flocking down to Austin. I'm gonna give you guys a little bit of some game real quickly here. Right? Here's some game. You know what state is right now in the South? Free game. Oklahoma. Booming right now. The state of Oklahoma is booming right now. It's so investor friendly, business friendly, and also consumer friendly. Certain areas of Texas as well. Also, again, I stay away from. I'm not saying that Austin and San Antonio are bad markets. They're not. To me, that right now, and Dallas as well, and Fort Worth, really just Dallas. It's just right now it's too inflationary happy for me, for my taste right now. You can still find some deals in those areas. Go find them. But again, until a new game. If you're in Texas, the city of Fort Worth, untapped market. Wow. The city and county of Tarrant County and the city of Fort Worth, for some odd reasons, investors are not there. The lion's share of them, some are there. The lion's share of them are not there. Everybody's in Dallas. I don't know why. But free game for those in Texas, Fort Worth and Tarrant County are ripe for real estate investing. So guys, interesting perspective from an investor standpoint, right? Or how the higher interest rates post the Fed cut have taken effect and has driven those rates up to where the profit margin, the delta or the spread, right, or the yield is smaller for investors because they don't know how to acquire at the right price point. Is that simple, guys? It's not that hard at all. Those that understand how to buy properties the correct way will never be broke ever again. What's good, y'all? LaDale Buggs here. Most individuals that I talk to today, they're really concerned about the economy, specifically the volatility of it. Number one, they're really concerned about inflation. Now, the area of their concerns really centers around the variable of inflation. Inflation right now is really outpacing people's wages, number one. And number two, it's beginning to affect their 401k and IRAs because their retirement accounts are connected or intertwined with the stock market. Over the years, I've been fairly successful in real estate investing. Currently, I own about $35 million worth of real estate under management. And also my partner and I have been able to build our private equity and venture capital firm to about $1.2 billion worth of assets under management. Now, this success has taken place in up or down economies. Now, whenever there's volatility in the market, opportunities begin to show up. There are 3 investment strategies that, if implemented the correct way, any investor can go from 0 to 6 figures in the next 6 to 12 months. Click on the link below or swipe up and let's talk through these strategies. All right, guys, we are back, man. Now we're gonna talk about what actually happens because of this spike in interest rates after the Fed cut its rates. What actually happens when it comes to the pricing of homes right now? Right now, guys, there's some details out there talking about home prices plummet to 14-year lows, right? To a 14-year low, and y'all, this is something to behold. And I try to tell everybody, man, this was going to happen because what was going in the bond market and the T-bill market, what's going on in that space will tell you how investors are responding to what the Fed is doing. Don't just make a decision based on what someone does. Look at the reaction to what someone does as well also. So let's dive in this real quickly, man. We have to go to our cats from Valuetainment, PBD, and the crew, man. They talk about this in detail and watch where they go. Listen to where they go on why this is happening when it comes to home prices plummeting to a 14-year low. Here we go.
Home sales on track for the worst year since 95. This is WSJ. Look at that chart, Vinny. Look at that chart right there. Craziness. U.S. home sales are on track on the worst year since 95 due to high home prices and elevated mortgage rates. September sale fell another 1% from all.
He just said home prices and also what? Mortgage rates. Sounds familiar to the previous video that we just talked about. That we just saw and went through line by line what he was talking about, segment by segment. Here we go.
August to an annual rate of 3.84 million, the lowest since October of 2010, with a 3.5% drop compared to the same period last year. Wow. According to the National Association of Realtors, Lawrence Young, NAR's chief economist, remarked that home sales are stuck at low levels and forecasted 2024 sales could match or fall below 2023 levels. Wow. Persistently high mortgage rates, which recently spiked after briefly dipping to a 2-year low, are deterring buyers. Michael Redd from Bridgeway Mortgage and Real Estate Services noted that trickle up in rates to right back where we are just sucked the air out. Mortgage rates driven by a 10-year Treasury note have been volatile, making home purchases more unaffordable. Tom.
Well, look. People are thinking that rates is the only thing connected to the market. And we talk about this. We say rates are going to help. But what rates usually help happen is more houses come on the market. Now, a lot of houses have been built this year. Lanier, Toll Brothers, and you can go look at the home builder indexes are way up this year. So they're actually building more houses. They're just not building as many as are needed. We need even more. And with more supply, the price comes down. So that's the first lesson. With more supply, the price comes down. Correct. And the prices haven't come down. And Florida had increases in insurance, home insurance down here. So the number of people, we'll take back to it again, that are willing to sell, mom and pop want to sell their house in Parsippany, New Jersey, and move down to Boynton Beach and retire. They're like, wait a minute, we still have $200,000 on a little mortgage. If we go down there, we're going to have to pay actually the same for a house. It used to be that you sold your house in Parsippany, you downsize and bought something smaller, and maybe even a small or no mortgage. Well, now they're saying, nope, we can't do it. The math doesn't add up, and we're going to have a little bit more insurance costs. So guess what? The prices haven't come down because the supply hasn't come down. Correct. And the supply is being held up by, insurance and property taxes and rates.
I got a question for you.
And so the banks got the rate cut but then they also didn't get an increase in demand. So if you've got low demand, you would think that price would go down to spur it. But the banks have said, nope, you know what? We're going to leave the rate right here at 6.25, right here at 6.5. We're not going down to 5, not going to 5.875, which they were for about a week.
Got a question for you. You're the president.
So the banks are trying to mitigate their risk as well by leaving the rates up at 6.25, 6.5%, because as Tom Brilliant said, they had not seen a movement from a house sales standpoint and house prices standpoint at all. But everybody was banking on the Fed rate cut at 0.5 point to spur their growth, and it is not happening at all. And again, it's because of two reasons, guys. DTI, debt to income ratios, right? Record high credit card debt, record low savings for the consumer. Number two, also inflationary rate is outpacing wages. So how can a consumer be approved for a new loan, right, at a higher price point, at a higher cost, at a higher insurance cost as well? They cannot afford the payment, guys. It's real simple. Let's keep going.
Okay, you get elected. You win. What are 2, 3, 4, 5 markers you have, Tom, to help this change so the average American can afford to buy a home?
Great question.
What are the markers?
I've got two. You've got drill, baby, drill, and that reduces the price of everything from shipping on their groceries to the gas in their car, to the fuel that heats their house, to the electricity they pay for their air conditioning. I make the United States an energy power because that is one button the president can push to get a lot of prices to come down. That's affordability. The second thing is I give a lot of incentives out to those home builders. We need homes built. We need more homes built because the supply is going to come up. And then the other thing that I would do is I would adjust the tax policy on when you sell a house. You usually get one time in your life, you know what I'm talking about, Pat, where you don't have to pay the capital gains. All the rest of the time, as long as you bought a house that was worth more, called a 1035 exchange, then you don't pay taxes on it. But I would give relief to incent the people that there is a lot of people in the Northeast that want to retire to a lower cost state. And I would take some of the tax off of that one-time sale so that they'd be more willing to sell and put those houses on the market. But we need more supply, and then you need to make life more affordable. I would also do something else, is that for federal, I would have federal flood insurance revamped. Because the catastrophic insurance is what is killing people in Florida.
Yes.
Basic home insurance has gone up, but it's nothing when you put the wind, the rain, and everything else on it. And so you got to do something about catastrophic insurance to help Americans.
Guys, I love what Tom just did. He looked at relief for builders, because we do need to build more homes, and for consumers. Guys, newsflash: consumers are what drives markets. Consumers are what drive markets, right? Not the government. Consumers do. So you have to incentivize the consumer to go out and borrow the debt to buy a house, because we're in a debtor nation, right? Our whole economic environment is rest on creating of debt. That's how money is created. Money is created via debt. So you have to incentivize consumers to go out and borrow the money to go out and buy new properties, right? Go out and buy new products and services. That's how money flows through our economic system. But you have to also incentivize also the builders as well, to give them some incentives, as I was saying before, to build more homes at the exact same time. I love the play concerning the insurance play and the tax play. I would say a tax there should be a tax adjustment for the builders, right? And for the consumers at the exact same time, to incentivize both parties to be able to move in accordance with one another. I like the 1031 exchange needs to stay in place. That's for sure. That's for sure for investors, And then I love the insurance play of I used to own a property in Florida. It's a 3-story, 7-bedroom. I'm sorry, 6-bedroom, 7-bath. Inside of the house was a pool. The backyard was the ocean itself, which is fine. And I paid 2 sets of insurance: home insurance and flood insurance. Guys, my flood insurance back then, that was what, 24 months ago, I believe. Or, my flood insurance was what? I think initially was $5,000 and it went up to $8,000 a year for flood insurance alone. And my insurance cost for the home was like $16,000. So in total insurance costs, this is in Florida, I'm paying $24,000 annually on insurance. And I haven't gotten to the HOA. They were trying to charge each homeowner there, I think $200,000 a year in for HOA. And guys, it was a very exclusive area, armed guards. We had a tennis club on there, restaurant there, private island, spa. I mean, it wasn't slouchy. It was very. We were spoiled. We were spoiled, guys. But so if you look at those costs, you have to do some of those costs for individuals to be able to say it's a proper a risk for me to go out and sell said home and or go out and buy a new home at this new interest rate itself and the price point. There has to be some type of concessions or incentives given via the government for the business, home builders, and consumers. This is when wise stewardship at a government, whether it be local, county, state, and federal, should walk in accordance to incentivize all of this. This is what I mean, that the government should not be a player in the game. There should be a referee. This type of environment is ripe for the government to be able to do exactly what they are supposed to do, which is what? Govern well for both the consumer as well as the corporation. It's real simple. Now, here are my thoughts, guys, concerning the market, right? Here are my thoughts. Okay. Is the market bad? It's not in good shape. Is it scary for some people? Yes, it is. Who's not scary for? Sophisticated investors who are ready or have access to wise counsel to get this accomplished. It's very simple. See, the Bible says, my people perish because of lack of knowledge. So if you are scared of what's going on with the market, what don't you know? Because people like myself, Cliff, Brian Adamson, I can go down the line, Dan Martell, Patrick Bet-David, Ray Dalio, any type of investor, Warren Buffett, we're not panicked at all. We see opportunity. There's a reason why Warren Buffett actually sold a lot of his shares in Bank of America. Why? To be flushed with cash, to be able to buy deals that'll be on sale. This is the reason why, guys, I say this here. This is the reason why this strategy right here, distressed property investing, is so key. Because if the right policy is not put in place to incentivize both the company and the consumer in this space to walk in accordance, and the government is not an active player, but they really play the role of being a referee. If this is not done properly, there's going to be so many sales. Even if it is done properly, there's still going to be sales. Either way it goes, the sophisticated investor, the wise investor, wins. That is the reason why myself and Brian Adamson, this is just the name of this, that's my brother from Detroit. We're doing this. We're saying, yeah, here we go. This is the SFR space, the multifamily space, and the apartment complex space. And also, guys, the public storage space as well. Man, I'm trying to told y'all, there's so much opportunity. Now, what is out there right now? So what's distressed property investing? It's very simple for those that don't know. I'll give you an image. You're driving in the car, and you're either going home or you're going to a friend's house. And you see a property that It says boarded up windows, high grass, paint looks terrible, horrible condition, right? Looks vacant, right? That's a distressed property. Or you see a house that is in fairly good condition, but as you're driving, excuse me, you don't see no one living there. Distressed situation, potentially, right? Burned down house, distressed situation. If you go to apartment complexes, 20% occupancy, distressed. 30% occupancy, distressed. 50% occupancy, distressed. Those are key factors into this, right? Those are distressed property opportunities. You have to begin to understand what these opportunities look like so you can then profit from these. Stop letting people like BlackRock, Vanguard, State Street be the only players in town that benefit from distressed situations. It's time for you to play this game. Get in the game, guys, because the next 3 to 5 years, this is going to be the best time in my lifetime, and I'm 45 years old, to ever invest in real estate. I was able to profit heavily in 2008, 9, and 10 because I was ready to buy distressed properties. I knew how to do it. Do you? Those that do, man, your pockets are going to be fat. Those that don't, feel sorry for you. Those that don't, but need some counseling or need some wise counsel on what to do, don't you worry. Your partner got you. This is the reason why, guys, when it comes to what we do, we are giving away. I am giving away a distressed property investing ebook. It's free. It don't cost you a dime at all. Excuse me, at all. I want to give it to you free. Now, Dale, why would you want to give it to somebody free? I'm glad you asked that question. Simple. If I can teach you how to locate a distressed property, vet the deal, put the deal together. Hey, guys, if the deal makes sense, I will fund your deal for you. We can profit share together. That is a crazy deal. But we're in a different time to where we're in an information age, and so information moves very quickly. And I thought it'd be wise, because I'm always asked if I could train somebody. The answer is always yes, right? This is the best way to train. It's a free book coming directly from a masterclass that me and Cliff actually taught, right? These are the actual notes, line by line. And we go through a strategy that you can do right now for free in your city or county and or state. I would say start with your city to where you can get a list of distressed properties in your city for damn near free. Now, some cities do charge a fee. It's very minuscule, but you can get a list of properties for free. We talk about how you can get that done in this ebook. If you could, guys, simple. There is a link below in the description area. You're welcome to click on that link below, or you can scan on this QR code. Again, it's completely free, right? Which is great. Or if you don't have if you don't have the ability to click on the link below or scan the QR code, don't you worry, your partner got you. DM me the word real estate. That word is on the screen. Real estate. DM me that word, and my team will get you over this exact same link that's listed below, as well as on this QR code. It's very simple, guys. It's real simple, and the ebook is free. It don't cost you no money for it. Don't need your money. Don't want it. Just to get the information. It's very simple. Now, guys, at the exact same time, some people also tell me, LaDale, I don't really want to invest in real estate because that's not my thing, and that's cool. I'm rocking with you. Real estate is not for everybody, and that's all good. Well, it's a good thing about it. We didn't forget about you at all. A friend of mine by the name of Matt Sapala did a free presentation. It's free, right? On the passive income blueprint. He goes over 3 ways for you to generate a significant amount of passive income, not commission, passive income, right? For you to generate a good return. This could be good for you to retire, to generate away from your job, to generate additional income while you work at your job as well, and for you to begin to build something to pass on to your kids after you, right? A wise man plans for 3 generations after them, guys. Now, if you could, guys, real simple, click on the link below in the description area, or you're welcome to scan on this QR code. Again, it is free. It'll cost you a dime. My whole intention is to get you the information so that you can make a good, wise decision that's best for you. I don't know what that is. Only person knows that is you. It's real simple. At the exact same time, guys, if you're not actually able to either scan on the QR code or click a link below, Don't you worry, your partner got you, baby. There's a word called passive income on this screen. DM me the word passive income. My team will send this link out to you. Again, it's a free presentation. Real simple for you to do. Very easy, guys. All right. At the exact same time, guys, everybody keeps asking me, LaDale, man, where you get your merch from? Because I look fresh, cold, clean in my ice cold drip. You see it, baby. Ain't no thing with it, man. Don't get mad at me because I look better than you. It's all good, baby. Now, real simple, guys. We do have I Got That Bag University merch is available right now as we speak, guys. Again, either click on the link below in the description or scan on your QR code. We got hats, we got hoodies, we got t-shirts, we got it all. Here's what I say. This is how you show your diploma. You actually show them the check that you just made on your deal, baby. That is your diploma. Show me that paper. It's real simple, guys. Well, if you want your merch, real simple, click on the link below, scan a QR code, which would be easy, guys, and then we can kind of go from there, guys. But guys, man, I hope we added some value. I hope that everybody got some type of inclination what's going on. I always tell everybody is look at what people are, how the market responds to an action by a government entity. Is it positive or negative? And you can really look at from an economic standpoint that bond and treasury bill section, guys. But guys, thank you so much. God bless you. You know, I end it every single time. Before you leave, baby, and while you can, you see that thing, baby. Take that damn picture and give it to your mom and them and holler at your partner. God bless you guys. See you next time. Peace.
Man, let's keep it 1,000. You are concerned about what's going on with this economy. I know I would be, man. You have the stock market not doing too well. You have inflation outpacing wages right now. And you have major companies looking at laying off a lot of people. Man, I had a friend of mine whose wife works for a major pharmaceutical company, and they're talking about laying off scientists, man. Scientists. It's getting real out there, guys. But hold on, wait a minute. It's not the end of the world for those that actually have a counter move. More than ever, it's time for everyday Americans to begin looking at a side hustle, a business for them to begin building now, and for them to be able to have the ability to pass their business on to second and third generation. Now, what business model is best for you? That's a great question, and the only person that can answer that question is you. The good news is a good friend of mine, Matt Sapala, actually did a good presentation on presenting the passive income blueprint. 3 effective ways to generate $1.5 million in passive income. The most powerful word in business is cash flow. And even a more powerful word is passive cash flow. I know because I've been able to live the life of my dreams because of passive income. Most individuals focus on commission-based, generating commission. What if you can actually generate $1.5 million in passive income that can change not only your life, but generations to come, guys? Click on the link below or swipe up, guys, and I think you'll be blessed with what you see. God bless you. See you on this side.